For nearly 30 years, Japan followed a monetary path that seemed almost impossible to the rest of the world. Interest rates near zero, year after year, decade after decade. While other countries raised rates, cut rates, panicked, or reacted to crisis after crisis, Japan stayed still, silent, stable, predictable. At first, this looked like a domestic choice, a policy designed to fight deflation, support an aging population, and stabilize a slow-growing economy. But over time, that decision grew far beyond Japan's borders. Without most people realizing it, Japan became one of the most important pillars of the global financial system. Not loudly, not officially, but mechanically. Because when interest rates stay close to zero for decades, something powerful happens. Money becomes almost free, and free money never stays local. Global investors quickly understood the opportunity. They could borrow money in Japan at virtually no cost, convert it into other currencies, and invest it elsewhere for higher returns. That single idea quietly reshaped global finance. Governments adapted to it. Corporations adapted to it. Banks, hedge funds, and pension funds built strategies around it. Japan became the cheapest source of capital on the planet. And that cheap capital did not just fund investments. It stabilized markets. It reduced volatility. It allowed debt to grow far larger than it otherwise could. Entire financial structures were built on the assumption that this condition would last forever. But permanence in finance is almost always an illusion. Because today, after nearly 3 decades of stillness, that pillar is moving. Japan has begun to change its interest rate policy. Not dramatically, not suddenly, but meaningfully. And when something that supported the global financial system for decades begins to shift, even slightly, the consequences are never small. To understand what comes next, we first need to understand exactly how Japan became the silent engine behind modern global finance, and why its move now matters far more than most people realize.
With interest rates near zero, Japan unintentionally created the perfect financial tool: cheap borrowing. Global investors realized they could borrow money in Japan for almost nothing and deploy it elsewhere for higher returns. This strategy became known as the carry trade. The logic was simple: borrow in Japan at near zero interest. Convert that money into dollars, euros, or other currencies. Invest it in assets that paid higher yields: U.S. government bonds, corporate credit, stocks, real estate, emerging markets. As long as interest rates outside Japan were higher and currency movements stayed relatively stable, the math worked. And for a long time, it worked exceptionally well. This was not a fringe strategy. It became a foundation of global finance. Banks used it, hedge funds used it, pension funds used it. Even conservative institutional investors quietly relied on it. The carry trade helped suppress global interest rates. It increased liquidity. It reduced volatility. It made borrowing easier for governments and corporations alike. Over time, Japan accumulated massive amounts of foreign assets. Trillions of dollars invested outside its own borders. Roughly $1 trillion of that money ended up in U.S. Treasury bonds alone. That capital helped finance America's growing deficits. It helped stabilize bond markets during crises. It allowed governments to borrow more at lower costs for longer. Cheap money started to feel permanent. Markets adapted to it. Risk-taking increased. Leverage grew. Asset prices inflated. And because nothing broke immediately, the system reinforced itself. The longer it worked, the more confident investors became. But there was always one hidden assumption holding everything together: that Japanese interest rates would stay near zero forever. That assumption is now being challenged. And when the foundation of a strategy that large begins to crack, the impact does not stay contained. It spreads, quietly at first, then all at once. And that is where the real risk begins. For decades, the carry trade depended on one critical condition: Japanese interest rates stayed close to zero. That single fact made the strategy safe, predictable, and profitable. But recently, something fundamental changed. Interest rates on Japanese government bonds began to rise. Not just short-term rates, long-term rates, 20-year bonds, 30-year bonds, even 40-year bonds. For most countries, these yields might not sound dramatic, but for Japan, they represent a historic shift. Because Japan is not just another economy, it is the anchor of the global carry trade. When Japanese yields rise, the entire math of the strategy changes. The gap between Japanese rates and US rates narrows. The reward shrinks. The risk grows. Suddenly, borrowing in Japan to invest abroad no longer looks like a free lunch. Currency movements become more dangerous. Small changes in exchange rates can wipe out years of profits. What was once a low-risk, slow-moving strategy becomes fragile. And when large investors sense fragility, they do not wait. They adjust, quietly at first. Positions are reduced. Leverage is lowered. New trades stop being opened. Then something more important happens. Old trades begin to unwind. Money that once flowed outward starts moving back toward Japan. This does not trigger headlines immediately. There is no single announcement. No dramatic crash on day one.
Instead, liquidity slowly fades. Markets feel tighter. Borrowing becomes slightly more expensive. Risk tolerance declines.
And because so many parts of the global system depended on that liquidity, the effects spread far beyond Japan. This is the moment where a technical change turns into a structural one. The global financial system is being asked to function without the cheapest source of capital it has relied on for decades. And systems built on easy money never adjust smoothly when that money disappears. They adjust painfully.
When Japanese capital starts flowing back home, the impact does not stay contained. It ripples outward, because for years, that money was quietly supporting the rest of the world. Less Japanese money abroad means less global liquidity. And liquidity is the oxygen of financial markets. When oxygen levels fall, systems do not collapse immediately. They weaken. Borrowing costs rise slowly. Credit becomes harder to access. Risk appetite fades. The United States is one of the most exposed. For decades, Japan has been one of the largest buyers of US government debt. That demand helped keep US interest rates lower than they otherwise would have been. If that demand weakens, the consequences are immediate. Treasury yields rise. Mortgage rates stay elevated. Corporate borrowing becomes more expensive. That pressure filters directly into the real economy. Businesses delay expansion. Consumers feel the strain. Asset prices face resistance. Europe faces an even more fragile situation. Many European economies already struggle with high debt levels and weak growth. They relied heavily on global capital flows to stay stable. When that capital becomes scarcer, old vulnerabilities resurface. Fiscal stress increases. Bond markets become volatile. Political pressure rises. Emerging markets feel the impact as well. They depended on cheap global credit to fund growth. As liquidity tightens, currencies weaken. Debt becomes harder to service. Capital flows reverse. This is how financial stress spreads. Not through headlines, not through panic, but through tightening conditions that compound over time. Each small increase in borrowing cost makes the system slightly more fragile, and systems built on leverage do not fail gracefully. They fail suddenly. Japan is not triggering a crash on its own. It is removing a support. And when a support that held the system together for decades disappears, the weaknesses underneath begin to show.
As capital begins to flow back into Japan, a new problem quietly emerges. Japan itself becomes more exposed. For decades, near-zero interest rates made Japan's enormous public debt manageable. The government could borrow cheaply. Debt servicing costs stayed low. Markets remained calm. But higher interest rates change that equation. Even small increases in yields matter when debt levels are massive. Japan's public debt is more than twice the size of its entire economy. That means every percentage point increase in borrowing costs carries serious consequences.
If interest rates remain elevated for long enough, debt servicing costs rise sharply. Government budgets tighten. Fiscal flexibility disappears. Political pressure increases.
Japan faces a difficult trade-off. Keep rates low and risk renewed currency weakness and imported inflation, or allow rates to rise and strain the government's own finances. Neither option is comfortable, and that tension creates uncertainty. At the same time, Japan's population is aging rapidly. A shrinking workforce means slower growth. Slower growth makes debt harder to manage. Higher rates amplify the problem. The country that once stabilized global markets now has to protect itself. This shifts priorities. Capital that once flowed outward to support global liquidity becomes needed at home. Japanese institutions grow more conservative. Risk tolerance declines. Foreign exposure is reduced. Balance sheets are protected. This does not signal collapse, but it does signal retreat. And when the world's most reliable source of cheap capital retreats, global markets feel the absence. Japan is no longer just a lender. It is a participant facing the same constraints as everyone else. And that changes the balance of the entire system.
From this point forward, the global financial system faces several possible paths. None of them involve a return to the old normal. The first scenario is a slow and controlled adjustment. Liquidity fades gradually. Speculation becomes less profitable. Asset prices reprice over years instead of weeks. Markets become more selective. Cheap money disappears quietly. Risk is priced more honestly. This is the least painful outcome, but also the least likely. The second scenario is sharper stress. Capital flows reverse faster than expected. Borrowing costs spike. Asset prices adjust violently. Highly leveraged investors are forced to sell. Volatility rises. Confidence breaks. This kind of reset is fast and uncomfortable, but it clears excess quickly. Then there is the optimistic scenario. Japan stabilizes inflation. Rates peak. Capital flows eventually resume. Markets adapt without major disruption. History suggests this outcome is rare. And finally, there is the scenario that concerns policymakers the most. A synchronized global strain. Japan pulls capital inward. The United States struggles to fund deficits cheaply. Europe faces renewed fiscal stress. Emerging markets deal with currency pressure. Liquidity dries up everywhere at once. When this happens, correlations rise. Diversification fails. Assets fall together. Central banks are forced to respond. But unlike past crises, they now face limits. Debt is already high. Inflation risks remain. Public trust is fragile. The tools still exist, but they are weaker, and markets know it. So what does all of this actually mean for you? It means the world is entering a different financial era. For decades, markets were supported by cheap, abundant money. Risk was rewarded. Mistakes were forgiven. Speculation paid. That environment is fading, not because of a single crisis, but because the system's foundations are shifting. Japan is no longer quietly supplying unlimited liquidity. Interest rates matter again. Capital has a cost again. This does not mean markets are about to collapse tomorrow. It means the rules are changing. Investments that relied on leverage become fragile. Business models that depended on easy refinancing face pressure. Assets priced for perfection lose protection. At the same time, discipline begins to matter again. Cash regains value. Balance sheets matter. Patience becomes an advantage. Periods like this are uncomfortable, but they are also honest. They reward preparation instead of speculation, understanding instead of emotion. Most investors lose money not because they lack intelligence, but because they misunderstand the environment they are in. This shift out of Japan is not a headline event. It is a structural change, one that will quietly influence interest rates, asset prices, and economic decisions for years. The goal is not to predict every market move. The goal is to recognize that the era of effortless liquidity is ending and to adjust accordingly. Those who adapt early preserve capital. Those who wait for clarity usually pay for it. This is not the end of the financial system, but it is the end of a chapter. And understanding that difference may be one of the most important advantages an investor can have in the decade ahead.